First, let's set the stage. The derivatives market is a massive, complex system where financial instruments derive their value from underlying assets. In our case, the underlying asset is currency. Among these instruments, currency options and currency futures stand out as vital tools for managing the risk associated with fluctuating exchange rates. Currency options are contracts that give the holder the right, but not the obligation, to buy or sell a specific amount of currency at a predetermined price on or before a certain date. There are two main types of options: call options and put options. Imagine an international corporation planning to acquire a company overseas. The deal is valued at 10 million euros, but the company is worried that the euro might appreciate against the dollar, increasing the acquisition cost. They can buy a call option on euros to lock in today's exchange rate. Let's break this down. The company buys a call option for 10 million euros with a strike price of 1.10 USD per EUR, paying a premium of 2 cents per euro. The total premium paid is $200,000. Scenario 1. If the euro appreciates to 1 euro equals 1.15 US dollars, the company exercises the option, buying euros at the lower rate of 1.10 US dollars, saving $500,000 on the deal. The total effective cost after accounting for the premium is $10.2 million, but the company avoids paying $11.5 million. Scenario 2. If the euro depreciates to 1 euro equals 1.05 US dollars, the company lets the option expire, losing the $200,000 premium, but buying euros at the favorable market rate, spending $10.5 million. In this way, the call option provides a safety net, allowing the company to protect against unfavorable currency movements while still benefiting from favorable ones. Now, let's move on to currency futures. Unlike options, currency futures are standardized contracts that obligate both parties to exchange a specified amount of currency at a predetermined price on a future date. These contracts are often used by businesses to lock in exchange rates for future transactions. Consider a multinational corporation that has sold goods to a European client and expects to receive 5 million euros in 6 months. They are concerned that the euro might depreciate against the dollar, reducing their revenue. To mitigate this risk, they enter into a currency futures contract. The company locks in the futures rate of 1.10 US dollars per euro for 5 million euros. In 6 months, regardless of the actual exchange rate, they will convert their euros to dollars at this rate, receiving $5.5 million. Scenario 1. If the euro depreciates to 1 euro equals 1.05 US dollars, the company benefits from the futures contract, as the market rate would have resulted in only $5.25 million. Scenario 2. If the euro appreciates to 1 euro equals 1.15 US dollars, the company misses out on additional revenue but avoids the risk of a lower rate. With currency futures, the company ensures stable revenue, avoiding the uncertainty of fluctuating exchange rates, even if they miss out on potential gains. To summarize, the key difference between currency options and futures lies in flexibility versus obligation. Options provide flexibility, allowing the holder to decide whether to exercise the contract based on market conditions. Futures, however, bind both parties to the agreed terms, offering certainty but no room for market advantages. In practice, financial managers and investors often use a combination of options and futures to hedge against currency risks. For instance, a CFO might use currency options to cover unpredictable market movements, while locking in crucial transactions with currency futures. This balanced approach helps businesses navigate the complexities of the global market effectively. That's all for today's lesson on currency options and futures. These tools are essential for anyone involved in international finance and investments. If you found this discussion insightful, don't forget to subscribe for more advanced lessons on financial instruments and their real-world applications. See you in the next video.